Hello Propenomix people, welcome to the supplement from the 3rd of December 2023. This one is about the budget in forensic detail, Charlie Munger, a bit of a soapbox rant, and of course your weekly dose on inflation as well. So as you know, I like to start with a quote, and this week's quote is of course from Charlie Munger himself. You don't have a lot of envy, you don't have a lot of resentment. You don't overspend your income, you stay cheerful in spite of your troubles, you deal with reliable people, and you do what you're supposed to do. All these simple rules work so well to make your life better. Charlie passed this week, just a month short of his 100th birthday, American investment legend. So, I just wanted to also give a shout out to the Propenomix Advent Calendar, because if you're listening on a podcast platform, it's worth checking out the Propenomix YouTube for the daily posts I'm doing throughout December, which are a celebration of getting to 500 YouTube subscribers. Thanks to all the regular listeners and everyone who's subscribed. If you haven't yet, what are you waiting for? So, lots to crack on with this week in the supplement, and it was really difficult to decide what would make the cut and what wouldn't. I've kept things as brief as possible without using the budget momentum to boot, and I start this week with the OBR, the Office for Budgetary Responsibility, or the Office for the Bloody Ridiculous as I prefer to call them, with their report, which provides the Treasury and the Chancellor with the fuel upon which to make a meaningful autumn statement. This is the very same OBR that Truss and Kwarteng tried to make a mockery of, before simply making a mockery of themselves instead, and a laughingstock of the UK, a little over a year ago now. I wonder when I'll stop referring back to that. Fair few supplements are bound to pass between then and now. Remember, the OBR is an independent team of 45 civil servants, so should be apolitical and should provide continuity between governments. A wise idea, the best idea George Osborne ever had apart from quitting politics altogether. It was an idea which to an extent was inspired by the benefits of having an independent central bank, which has turned out to be a positive. Doesn't make them bulletproof, of course, because they're still only as good as the people in charge. To line by line the executive summary would have taken this week's effort into record territory, because the summary itself is massive with 26 expanded points and 7 charts. So we'll have to stick with some modified highlights, I'm afraid, although I'm sure you'll thank me later. The main moral of the story is that GDP after inflation adjustment in the middle of this year was 3% above where the OBR thought it would be in their March forecast. That sounds like an awful lot, but there has, remember, been a revision in calculation which explains nearly 2% of that. Either way, 1% of GDP, the pocket change, is still £25 billion or so quite a miss on the forecasts. The OBR accepted this, but have also revised their forecast downwards for the future, which did look quite hopeful back in early 2023. But they were expecting a bit of a rebound from a particularly bad year this year. They were 1% out only a few months before, but this justifies my tearing apart of the OBR forecast from earlier this year in this very supplement. That's a horrific piece of forecasting right there. The OBR now sees inflation down to 2% by early 2025, which has always been my rough timescale, even going back a few years, solely by looking at historical trends and similar situations in other countries. One of the problems our forecasters have is that they think they are smarter than their equivalent forecasters were and economic predecessors were, and the evidence is they're just about the same as they've always been. I could be on board with that, however, Q1 or Q2 2025 for target inflation. The bigger miss, though, has had a profound effect. Hunt had much more money in his metaphorical pocket in the November statement than the OBR expected. That's because everyone knew the tax thresholds were frozen, but didn't think inflation, in both prices and wages, would swell the tax revenues quite as much as it did. Think about why here. Price of goods goes up more than expected. What do most goods have on them? Value added, in air quotes, tax, sales tax in international parlance. What about services, inflating at a strong rate as discussed? Yep, VAT. Then incomes rise more than expected. What happens then? Income tax receipts higher, than expected because of thresholds for basic rate, higher rate and every other tax going pretty much being frozen. Income tax and VAT are simply the big two of tax, so these receipts make a really sizable difference to the tax take, which is now around 37.4% of GDP, by the way, the highest burden since World War II. Don't worry though, we're on the road to 38% of GDP thanks to these threshold freezes by 2028. The only way this gets better is if we outperform this OBR forecast as well. There's some semantic points that worry me a little as well in this report. The implication is that there's been a full recovery from the pandemic. Of course, numerically it appears currently that there has been. However, it's left us with trailing inflation, far higher interest rates than anyone, apart from a risk-averse saver, would like, and a huge debt burden on top of the burden we already had. A recovery in GDP, sure, but problems down the track, surely. The OBR doesn't see inflation below 4.8% in the fourth quarter, although, of course, we're already below that. That doesn't inspire much confidence either, but you'd expect they're not suggesting much of a drop before the end of December in CPI. Their 2024 inflation forecast is basically a line sloping downwards from 4.8 to 2.5 or so. I wouldn't be overly confident in the model they're using here. The gilt yields, of which I talk about so much, are 1 to 1.5% above where the March forecast was, and so they see the bank base rate settling at around 4%. This seems historically unrealistic to me. I still feel 3 to 3.5 base would be a better stab for base in a few years' time. In these lengths of time though, it mostly feels like guesswork, especially given that they can't seem to get a forecast right when it's only a few months away, let alone a few years. Their medium-term growth rate has also shifted from 1.8% to 1.6%. I feel as though this economy will struggle to grow at more than 1.5% in reality going forward, although AI offers some major productivity potential. Perhaps at the expense of unemployment, of course, but remember how GDP is measured. The overall improvements since March, however, see a GDP 0.6% higher in real terms in March 27 than the previous forecast did. Not everything, but not small change. The OBR sees a 0.7% growth rate next year, which sounds about right for such a stagflationary environment like the one we're now in. Now, in spite of all revisions on growth, there's a recognition that real GDP per capita, a better measure of how well off or not people are, is 0.6% lower than in 2019. In a simple way, we've only grown overall because we've imported more people. The OBR only sees us getting back roughly to where we were in 2019 at the beginning of 2025, i.e. after the election. However, with net migration still likely at the 400 to 500,000 level in my view, I don't see us getting there if we only grow 0.7% next year. We grow 0.7, population grows 0.7, GDP per capita stays where it is now. That's a much more likely meaningful forecast in my view. It stuns me that at this level, the report informs the Treasury, remember, about what decisions to make in a national budget in UK plc, a company with a turnover of 2.5 trillion or more, that such glaring holes can appear in the logic. If anyone listening can help me understand where I'm going wrong, I'd be grateful. Surely it's something I'm missing. You'd hope so, wouldn't you, given I'm an army of one. The overall result of Hunt's budget are positive in the forecasts. But really, as I said last week, this is not really news. It's just a sign of how surgical Hunt is in his use of all of this data and making changes that cook the books in the best way. This isn't a criticism, but since we can't trust the forecasts, it isn't a cause célèbre either. The OBR sees unemployment at 4.6% tops in early 2025, and then back to 4.1% with a base rate of 4% for the Bank of England. Again, for me, those things just can't add up. That just doesn't feel like the natural rate of unemployment for the UK as things stand. I'm going to be surprised if we don't go above 4.6% next year, let alone 2025. The wage rises are too much, and if prices hold, as they've started to in the US and Europe at some point next year, then companies will simply have to cut jobs in order to appease shareholders and preserve profits. And that's exactly what they will do. Remember, as at today, we're at 4.2 to 4.3% unemployment, depending on what side of the bed the ONS gets out of. The OBR prefers a measure of living standards as real household disposable income per person, or RHDI, which is a decent enough measure. It's far lower than the GDP per capita figure suggests, even though GDP per cap is adjusted for inflation. Why? A few reasons. Households with lower average numbers. Migrants, for example, often come as a household of one, which lowers the average. And of course the word disposable here, the tax burden. We're expected to be 3.5% worse off in average household terms by the time the election rolls around, basically, compared to 2019. Enough to really feel it. I still maintain that it will feel better next year than it does today, and that relativity will help, but that's a big drop to stomach for the electorate, of course. Now the next part is a biggie. Government departments are 20 billion worse off in real terms than expected thanks to inflation. That's compared to the March forecast again. This is exactly where Hunt's tax cut money could have gone, but didn't. It isn't big money, I know it sounds like it, but when it comes to government spending these days, however, to dismiss it as being found by inefficiencies being ironed out in the system, which is the official government line, is a well-thumbed and unproven line from the old austerity days, before we go into the new austerity days. Fairly frightening. Government spending at nearly 45% of GDP is historically very high for the UK, and is now forecast to fall just under 43%, still high by the conservative historical standards. This will require some fairly significant cuts, already promised by Hunt to appease international bond markets when he was sweeping up after Truss and Kwarting, to be honoured by the next government. The alternatives are limited other than stimulating growth, which is easier said than done. There's lots around long-term borrowing in the report, but I can summarise easily. As per usual, we will stop borrowing at some point, just not quite yet, and we'll be borrowing less than we have for 28 years in 2029 at a small 1.5% of GDP, compared to 15% during the pandemic. Let's just see how we go on that one. The OBR does, in fairness, recognise that their forecasting has been pretty ropey because of all of the unprecedented rises and falls in various metrics since the pandemic. I'm glad they do, because it has been. However, when will the next unexpected shock not come? I'm not too hopeful on that front. There's perhaps only one light on the horizon. There's a consultation on vaping duty, which is long overdue and of course could raise some fairly significant revenue. Cigarettes raise something in the region of 10 billion per year. Not sure just how much more could be raised from taxing vapes, but several billion you'd think. In terms of the sort of numbers in these forecasts though, you're talking around 0.2% of GDP. Not nothing, but certainly not everything. Okay, enough OBR. Well done for sticking with it. Effectively, the future is pretty flat and quite treacle-like, as I've said this year might well be like, but it's improved a shade. If there is that likely change of government next year, then I will watch with interest for the relationship between the OBR and the figures once Rachel Reeves has the red case. On to the macro and some of the reports and metrics released in the most recent weeks. Mortgage approvals were higher than forecast, beating forecast by about 5%, but at 47,500 or so for October, we're still about 25% below typical pre-pandemic trading. Symptomatic of a market that won't behave as the perma bears want it to, but is genuinely struggling with the price of credit. Net mortgage lending barely changed, a minor net repayment, but the market overall remains more than 10 billion smaller than it was in March 23. Those are also October's figures, so when November's are available, I expect there may have been a minor net borrow again, as the rates and the market only started to repair the more recent damage some way through October. The Nationwide also released their November figures, and instead of the expected minus 0.4% drop, November proved to be the second up month in a row, and now shows the market down 2% year on year, according to Nationwide. Only a few months ago we were down 5% year on year, according to them, remember. The month on month was 0.2% up, and it prompted a few to point out that once again it would appear the big forecasters have got it badly wrong by being so bearish about 2023. Historically, it's also fair to point out that the typical fallout after a Liz Truss style change in the yields, a massive revision upwards, would take perhaps 18 months to play out. So it would have been wiser in 2022 to predict a bad year in 2024 than 2023. We then saw significant repair to rates in the earlier days of the Sunak administration, before struggling once again with rates in mid-23, which again would make predicting a bad year in 2025 more useful than predicting a bad year in 2024. You see the inherent problem with forecasting here. When the facts change, you should change your mind. This is all against the backdrop of inflation and the impact of that on a nominal pricing market, where prices are measured in pound notes, even when those pound notes simply do not buy the same level of goods, services and experiences that they used to. That's the really juicy bit that the forecasters have missed out. You could take a completely different viewpoint and praise the current administration for doing very well in such an inflationary time. Keeping pace with the price rises and not going into recession is actually a great feat, but only a great feat if you conquer inflation and crack on without recession being an inevitable consequence. That whole story took an interesting turn this week. We've got a new inflation buzzword, ladies and gents. Profit-led inflation. What is this concept? Well, in its recent context, it has been popularised by UBS chief economist Paul Donovan, who splits the recent inflationary cycle into three parts. Firstly, for durable goods during the lockdown, think hot tubs and rowing machines. Then for commodities, and we've all seen what happened to energy prices, which would be included in that part of the cycle. And then for profit margins, which companies are, of course, always keen to preserve. It's probably obvious that most companies would not miss a good chance to put a price up. You'd expect them to be pretty smart when opportunity knocks, and if you consider the builders merchants, for example, you'd remember that they were still trying to force prices upwards long after the commodity prices of things like lumber had already peaked. They got into a place where the market was swallowing these price rises and just kept trying until the market said no. And then competitive instincts kicked back in, but of course they tried to maintain these new higher profit margins. The fact they were selling more products to finish existing jobs, while simultaneously pricing out a load of potential new jobs, was perhaps lost on them, and is also very difficult to measure. So that would remain a theory rather than something I've got data to back up, even if that theory makes good sense. But I would say that, wouldn't I? Because it's my theory. So, under the cover of other general inflation and also wage inflation, companies use the opportunity to expand their margins. All very believable. Donovan suggested using something like social media to inform customers this is going on might be less destructive than just raising rates, which is the more traditional approach. Using collective consumer action to force or shame companies into stopping these practices, basically. It seems reasonable to include some element of fairness into any pricing model. But of course, the problem is that the price that I think is fair, or that you think is fair, is likely to be different from one another, or from another third party's idea of a fair price. In aggregate, though, the market would decide. It also seems reasonable to assume that the average consumer sees a price go up and assumes a greater profit margin, just as when they see a price go down, they assume a lower profit margin. Whereas it might be completely cost-driven and this might just be an illusion. Companies do, as a rule, tend to try and explain cost increases particularly, as we saw with the builders merchants in 21 and 22. The element to which their customers trust these explanations will depend on the brand and the level of trust they have within their customer base, of course. It could be as simple as the fact that the need to raise prices was huge during the pandemic because of volatility in inputs. We all know that it is the case that prices go up very quickly when something changes on the cost front, oil at the pumps, or base rate tracker mortgages when things go up, but come down more slowly when the reverse happens. We also know that businesses are bound to be opportunists. The profit margins are more likely to shrink now, though, as the rate hiking is largely done, and instead cuts are on the horizon, certainly in the US and Europe. Margins have likely increased because customers and companies have picked up the input that has gone up the most and then put the prices up by that input. So let's say wages are up 8%, but materials are up 12%. If prices go up by 12%, the overall margin will improve. since not all the costs have gone up by that 12%. I remain unconvinced about all this. There has been no evidence found by the Bank of England, who have investigated, that this sort of profit-led inflation, or greedflation, has been going on, despite the good sense that it makes. I'm not sure how hard they've looked, because margins have generally improved. But the problem is that current forecasts show further profit growth next year, whereas in my seat that looks particularly unlikely, especially in the UK and especially after the autumn statement. There's a further spanner in the works, though. Inflation has very much lost pace in the US and the Eurozone, and that's inspiring the chat about rate cuts coming forward. In the US, services inflation has abated from 6.8% in April, that was our September number, to a still high 5.05% for October. And it doesn't dominate their CPI number quite as much as ours does in the UK. There's a bigger relative drop in the Eurozone, who never saw services inflation above 5.6%, whereas we were as high as 7.4% in July this year. EU services inflation is down to 4% now, with a relatively steep drop-off in this past month. As with most of this cycle, we still appear to be roughly 6 months behind the big two. Their chat about cuts is deafening now, whereas ours is still more hopeful than real. I'd be surprised if we cut as early as they do. Lagarde, the president of the EU Central Bank, is still convinced that inflation is going to bounce back a shade, although has tempered her talk from no cuts in the next couple of quarters, that was the mid-November narrative, and markets are pricing in a 70% chance of a rate cut in April next year. This phenomenon, understandably, has had a big impact on the bond yields in the US and the EU this week, and there was an associated drop on the UK gilts as well, as this so often is. The magical 4% barrier was once again broken to the downside on the 5-year UK gilt on Wednesday, and whilst the yield traded back above that in the interim, Friday's close was 3.955%, which is more than 20 basis points lower than last week's close. The SONIA swap for the 5-year is trading at a razor-thin margin above the gilt, again perhaps symptomatic of supply and demand alongside greatly reduced volatility, at 4.04%, which sees 5-year rates at a 5% pay rate and a 5% fee as a very plausible option indeed. That would be for a vanilla buy-to-let deal. Most recent experience in the field has been 5.15 with a 5% fee or so this is an improvement. This segues me nicely into a soapbox moment for today. For the past 12 months, I've taken some issue with some of the advice I've heard being pumped around mortgage debt, and I'm increasingly aware that I've taken a fairly lonely position in this market. I perhaps earned my stripes in 2022 when talking about what rates might well do. Inflation, risks being to the upside, and spending most weeks shouting about the fact I was breaking mortgages to fix at the lower rates, or similar. I wouldn't change a thing. However, by continuing on the 5-year bandwagon, I've been in a relative minority. Sometimes I feel people are too scared to correct me or challenge me for some strange reason. I love feedback and I love debate, and I certainly don't expect to get everything right. Far from it. Let me lay out my overall position. Firstly, risk remained to the upside, and some events, the Middle East would be a good example, simply haven't turned out as badly from an economic point of view as they easily could. Things also, sadly, aren't over yet. The pandemic taught us so much, all of which we already knew, but didn't have at the top of our strategic plans. One lesson we all need to remember is that massive volatility can occur as long as there's a catalyst for it. Volatility is the enemy of long-term investors for a few reasons. One is it can shake confidence. 2 is that it can lead to support or credit being withdrawn or dramatically changing in price. The latter has been the fallout as far as property investors using leverage are concerned. The rest of the world showed greater stability by having longer-term debt cycles. 2 years is simply not long enough for a mortgage. At the current speed of many conveyancers, it looks more like a bridge term, for goodness sakes. There's a strong argument that 5 years isn't long enough. Remember, the rest of the Western world tends to use 30-year fixes, if not even longer. Frictional costs are rising, and have risen. The amount of administration required is also significantly higher than it has ever been before. The number of extra reports requested by valuers has also rocketed in recent years. Have you really got time, and have you costed in all of those frictional costs for all this to come around again in 2 years' time? 2-year loans are often used in the early or mid parts of a boom cycle. The point is that extra equity can be released and used to go again and offer more momentum. It has never been something which I've used in my business model, because I've found more edge in buying really well rather than concentrating on squeezing what I've got to death or over leveraging it. With a 5-year cycle in anything like a normal market, you get near the end, and your new purchases may well be being geared to 75%, but your older ones that are nearing the end of their first 5-year cycle will hopefully now be 60 to 65% organically. This isn't done for you automatically in a 2-year cycle, and thus you are more likely to be at a risky gearing level. When LTV moves above 60%, and this number is massively yield sensitive, I should say, the risk does not go up in a linear fashion. It's not a straight line. Instead, it rises more like a parabola, a curve, and as you go above 75%, that steepens even more. It is unlikely, if you operate a portfolio like this, that you can withstand a significant shock, and also it's unlikely you're getting a fair return on the level of risk that you're taking. In times of volatility and rate changes, the other big concern should be credit conditions when you come out of that loan. If credit conditions are tightening, what if that loan isn't there in 2 years' time? You could argue the same applies in 5 years, and that would be true, but it gives you longer for things to settle down, and more options if you need to take action 1 year away from redemption. You barely have time to breathe in the 2-year product. So, bearing all that in mind, imagine my disappointment this week when I learned that one of my consultancy clients was in the final stages of taking out a 2-year product. My immediate feeling was that I'd failed them by not laying out this position clearly enough. The product in question was a 7% fee, for 2 years, and a near 5% pay rate. Why was this so very expensive? Well, the property in question had some quirks, and also the loan had been requested several months ago when the 2-year yields were so much higher. It's gone to offer some time back, and the chances of a lower deal at today's pricing are long gone. Using my back of the envelope method, that's an 8.5% cost per annum, without thinking of the legal and other frictional costs as well. What a nightmare. I'd suggest even bigger is the hassle of going through this process all over again, starting in about 18 months' time. I understand the conventional wisdom at the moment has been saying, why would you fix for a long time when rates are so high? My mantra is much more like, if I am not fixing for at least 5 years, there needs to be a really good reason as to why I'm keeping the property. If it doesn't stack today, then should I sell it instead? It might be that year 1 and 2 are relatively underwhelming, but with a good asset management plan and a landscape which is expecting, and seemingly can afford, significant rent rises over the next 5 years, the 5-year forecast and years 3, 4 and 5 look much more promising and interesting. The 5-year forecast using a 2-year product has just got so much more uncertainty in it. That's not even our last problem though. The last problem, promise, is that the guesswork that's been going into the statement, rates will go down over the next 2 years. Let's take a look. I first started hearing this in October 2022. So 14 months ago, in a 2-year cycle, a lot of the time. The 5-year bond is today just under where it was in October 2022. A nearly unnoticeable drop. There have been periods this year where it's been a fair bit lower, and also periods where it's been 1% higher than it is today. There's been significant volatility, but we know that. Enough of a drop in 14 months to justify a 2-year product? Absolutely not. The yield curve is inverted currently, so 2-year debt has been more expensive than 5-year, sometimes a lot more expensive. Well, that definitely doesn't help, and why expose yourself to a bad part of the yield curve when you don't have to? Most cannot even start to calculate where the rates would need to be in 2 years' time to justify their decision. That calculation will never get done. I suggested a couple of weeks back that the implication in the yield curve is that 5-year rates will be around 3.5 to 3.6% for the gilts, and so 5-year mortgages in a year's time might look like 4.6% with a 5% fee, or a higher pay rate and a lower fee for limited company. This is simply derived from the yield curve crudely rather than a prediction from my own model. Worse still, it won't matter if I'm right or wrong, because like everyone, I'm a price taker in this market, not a price maker. The likelihood, though, considering all of the above, that taking a 2-year product is a dominant strategy for a long-term portfolio player is low. I choose my words carefully there, though, of course. Of course, there can be good reasons to look at alternative products in terms of duration, or anything else. 5-year is inflexible, and early repayment charges are high, as costs of breakages go up in times of volatility and in times of higher rates. You may well want to explore selling in 2 years' time, or you might know that you're going to. That therefore makes sense to pay the ferryman. Maybe. The only way to know is to do some accurate, month-by-month cash flow forecasting, or get your bookkeeper or accountant to do it for you. Then look at the likelihood of those scenarios. Or, fail to plan to fail on every investment. And whilst I'm on the rant bus, I wanted to discuss a post I saw get some traction on social media very recently. The thrust of it is, I've sold up and my money's in the bank now. Better returns and I needed a lesson. I've taken my medicine. Perhaps fairly clear that property was not kind to that individual in terms of returns. Lots of ways to interpret this, and as usual, the comments offered the most insight. First sort of comment, you're an idiot, mate. Second sort of comment, I'm the same, selling up when my tenants leave. There are a lot of people saying that. And then the third one, how could you possibly get better returns in the bank than from property? So, it probably seems obvious that those espousing the third comment are doing okay from the game, whereas those saying they're selling up when tenants leave are feeling the pressure. Those calling the original poster an idiot are just your average social media troll. I read these posts and it reminds me just how very little people know or understand about investment outside of property. Firstly, and I can make 50 relevant points here, bank rates today are unlikely to be reflective of bank rates in the next 10 years. Fine going into a bond today at 5% interest for a year or similar, although those rates have dropped like a stone in the past few months, far more sharply than the mortgage rates for 5-year fixes, because shorter duration is always more volatile. Secondly, 5% in the bank before tax is still losing money to inflation, unless you're a non-taxpayer or have such a small amount in the bank it isn't going to make any difference. Inflation is likely to stay around the 4% mark over the next 12 months, so perversely you were better off at 1% interest with inflation at 0, although that's hard for people to get their heads around for whatever reason. Thirdly, by dipping in and out, which the original post suggested, of course returns have not been positive. Frictional costs are high in entry and exit to property, and unless you're a great trader, you're highly unlikely to make it work if your time horizon is less than 10 years. This needs to be understood and repeated. I'll close this week simply by referring back to a legend of investing that we've lost this week, as I mentioned at the beginning of today's supplement. Charlie Munger, RIP. It's somewhat strange to use so many quotes from Buffett and Munger as I do, because neither really favoured property, or real estate as they would prefer to term it, as a great investment class. That, however, is where I will part company with the great men. Anyway, to Charlie, and why investment is a long game, not one to dip in and out of. It also ties in nicely with my 2-year mortgage rant above. You're paying less to brokers, you're listening to less nonsense, and if it works, the tax system gives you an extra 1, 2 or 3 percentage points per annum. So well done for getting to the end as always. And if you haven't heard, I did get to my 500 subscriber target by the 1st of December, and the Propenomix Advent Calendar is also online on YouTube, with a release each day. One 60-second explainer video and one longer form but under 10-minute video. Subscribers are, of course, very, very welcome. And please tell your friends to like, comment and subscribe alongside doing it yourself. Thank you very much for supporting. And remember, more subscribers will lead to more and better content. Even in a week of losing some big names and a true Goliath in the world of investing, we only have one choice. Keep calm and carry on.